Welcome to Motivation for Wealth, where we break down the secrets of financial success and wealth-building strategies used by the world's richest. Today, we're diving deep into the money-making machines of the ultra-rich in New York City. How do billionaires in the Big Apple turn millions into billions? What strategies do they use to multiply their wealth while others struggle to get ahead? From real estate empires to high-stakes investments, from exclusive hedge funds to powerful business networks, we're uncovering the exact moves that set them apart. If you're ready to learn, apply, and level up your own financial game, then hit that like, smash that subscribe button, and let's get started. Hey everyone, today we're pulling back the curtain on one of the world's most exclusive clubs, New York's ultra-rich. How do they transform millions into billions in a city where competition is fiercer than a Wall Street trading floor? What secrets let them build empires while others barely scrape by? Buckle up, because by the end of this video, you'll know exactly how they dominate and how you can steal these strategies to fuel your own rise. First up, real estate. In New York, land isn't just dirt, it's a golden ticket to generational wealth. The ultra-rich don't just buy property, they treat it like a high-stakes chess game. Take 432 Park Avenue, the $3 billion Needle Tower, where penthouses sell for $88 million. Investors here don't passively sit on condos, they leverage like pros. They secure ultra-low-interest loans against their existing assets, reinvest that cash into more properties, and let tenants cover their mortgages. It's a cycle: buy, borrow, repeat. But here's the kicker. They're not just hoarding luxury apartments, they're quietly monopolizing commercial real estate, parking garages, and even entire blocks. Why? Because in a city with only 23 square miles of prime space, scarcity equals power. Control the land and you control the cash flow. For example, Hudson Yards, a $25 billion mega project, was fueled by billionaires betting on Manhattan's last undeveloped frontier. They rezoned, built vertical cities, and now profit from offices, retail, and sky-high rents. And it's not just about buying, it's about timing. They swoop in during downturns, think 2008 crash, to grab distressed assets at fire sale prices. Then they hold until the market explodes. Even smarter? They use tax loopholes like 1031 exchanges to defer capital gains when selling, funneling profits into bigger deals. The lesson? You don't need $100 million to start. House hack a duplex, reinvest rental income, and scale. Remember, every skyscraper began with a single brick. Ready to play the game? For the ultra-wealthy, diversification isn't just a strategy, it's a hyper-engineered system of control. Beyond stocks and bonds, they dominate entire ecosystems of value creation. This starts with institutional-grade investments. Hedge funds managing $100+ billion portfolios, private equity firms acquiring swaths of industries, and venture capital arms funneling capital into pre-IPO tech disruptors. While retail investors chase public markets, elites operate in opaque, high-yield arenas where a single deal can outpace decades of 401k returns. But the game extends further. Art as a financial weapon exemplifies this mindset. A $195 million Warhol isn't merely a trophy, it's a tax-optimized, volatility-proof store of wealth. Unlike stocks, blue-chip art rarely correlates with market swings, and elites exploit free ports, clandestine warehouses in tax-neutral hubs like Geneva or Singapore to hoard masterpieces. These vaults let assets appreciate tax-free for decades, turning Picassos into compounding machines. The true edge, however, lies in strategic patience. When markets implode, the wealthy don't retreat, they attack. During the 2020 crash, billionaire investors pounced on undervalued energy infrastructure, distressed retail chains, and cratered real estate. By 2023, those bets delivered 200-300% returns. This isn't luck, it's a calculated playbook. Teams of analysts scour bankruptcy filings and geopolitical shifts to identify fire sales, while offshore trusts lock in tax shelters. Exclusivity supercharges this advantage. The term family office refers to private wealth vehicles managing 500 million plus portfolios, granting access to deals invisible to mainstream investors. Picture invitation-only summits in Swiss Alps resorts or Manhattan penthouses, where founders pitch the next quantum computing unicorn over single malt scotch. These networks operate on a velvet rope economy. If you're not in the circle, the deal doesn't exist. Meanwhile, retail traders fixate on meme stocks and crypto hype, unaware that the real wealth sits in alternative assets. The elite allocate 30 to 40% of portfolios to private equity, 15 to 20% to hard assets, timberland, lithium mines, vineyards, and use the remainder for tactical stock plays. Offshore structures then cloak these holdings, turning gains into ghostly, untouchable capital. Your move: think like an architect, not a gambler. The lesson isn't to mimic billionaires, but to adopt their scaffolding. Start with fractional platforms, own slices of fine art via Masterworks, join startup syndicates through AngelList, or explore REITs for real estate exposure. Cultivate niche expertise, AI, carbon credits, rare minerals, and leverage communities on LinkedIn or niche forums to spot trends early. Diversification isn't just spreading risk, it's about embedding yourself in value chains before they explode. Let's cut through the noise. What separates New York's self-made titans from the rest? It's not just grit or raw talent, it's who knows your name. Behind every skyline-altering empire, there's a hand-picked tribe of power brokers, innovators, and dealmakers operating in the shadows. In this city, wealth isn't built in isolation. It's forged in private rooftop lounges, at high-stakes charity galas, and in the hushed corners of exclusive institutions where a single conversation can alter the trajectory of a career. While outsiders chase hustle culture, the city's elite understand a harder truth. Access is the ultimate currency, and your network isn't just a safety net, it's a trampoline to stratospheric success. Picture this. You're debating blockchain's future with a tech investor at an invite-only art auction, or negotiating terms with a private equity titan during intermission at the opera. This isn't daydreaming, it's Tuesday for those fluent in New York's unspoken rules. The city's most influential players treat relationships like appreciating assets, cultivating connections that compound into life-changing opportunities. As one renowned entrepreneur once noted, your network is your net worth, but only if you're playing chess while everyone else is stuck on checkers. Consider the blueprint of modern empire builders. A media mogul didn't just create a financial data giant, he transformed decades of cultivated Wall Street alliances into a multi-billion-dollar monopoly. Today's disruptors follow the same playbook. They don't chase markets, they invent them. Companies that redefined entire industries didn't outperform competitors. They made competition obsolete by rewriting the rules. From revolutionizing how we use real estate to turning physical spaces into cultural currencies, the goal is always domination, not participation. But here's the secret hiding in plain sight. New York's elite don't fear failure. They weaponize it. When a shapewear startup's first prototype bombed, its founder cold-called luxury buyers between shifts selling office equipment. Setbacks become randy for reinvention. And once these visionaries gain footing, they expand with surgical precision. The sharpest minds don't just build products, they control entire ecosystems, from supply chains to distribution networks, ensuring every layer of an industry feeds their vision. This isn't mere entrepreneurship, it's high-stakes strategy disguised as socializing. While most professionals chase LinkedIn connections, the city's top 1% broker yacht meetings with sovereign wealth advisors. They don't apply for jobs, they acquire companies. They don't beg for investors, they command rooms. Their power lies not in what they know, but who they can mobilize before the competition finishes their morning coffee. The real question isn't whether you're working hard enough, it's who's working alongside you. Is your inner circle a revolving door of predictable contacts or a curated alliance of game changers? In New York, the difference between millionaires and billionaires often boils down to dinner invitations. That stranger beside you at a luxury hotel bar isn't just sipping cocktails. They're scanning the room for collaborators capable of launching their next venture. This city operates on a simple equation. Proximity equals possibility. Every handshake at a members-only club, every conversation at a premiere, every introduction at a philanthropic summit carries latent potential. The ultra-successful don't network. They architect human constellations designed to ignite opportunities invisible to others. So ask yourself, are you building a career or assembling a coalition? In New York, legacy isn't about the zeros in your bank account, but the caliber of minds in your orbit. The clock is ticking. While you're listening to this, someone's closing a deal that will reshape an industry. Will you be at the table or on the menu? Welcome to the invisible battlefield, where relationships are the ultimate leverage. Time to rethink who gets your business card and who gets your ambition. Remember, wealth isn't grown, it's engineered. Control the board, influence the market, and always stay 3 moves ahead. New York City, a global symbol of ambition and excess, has long been a magnet for the ultra-wealthy. Its gravitational pull stems from more than just Wall Street's financial clout or Fifth Avenue's luxury boutiques. It's a nexus of power, culture, and innovation. Home to over 100 billionaires, the city boasts iconic landmarks like Central Park, Broadway, and the Met Gala, but its true allure lies in its unrivaled ecosystem of opportunity. Towering skyscrapers, over 300 exceeding 500 feet, pierce the skyline, including engineering marvels like One World Trade Center, 1,776 feet, and Central Park Tower, the world's tallest residential building at 1,550 feet. These steel and glass titans aren't just offices and penthouses. They're vaults storing generational wealth, with apartments trading for $100+ million. Yet beneath the glittering surface lies a high-stakes chess game: tax optimization. The elite don't merely save, they strategically restructure. Family offices, over 1,000 in the US alone, deploy teams to shift assets into dynasty trusts in South Dakota or Nevada, where fortunes grow tax-free for centuries. Offshore structures in the Cayman Islands or Switzerland cloak investments, while art philanthropy tricks let donors claim 30% appraised value deductions for gifting Picassos to museums. Even relocation is tactical. Billionaires like Carl Icahn and Paul Singer fled New York's 14.8% top tax rate for Florida's zero-income tax haven, saving 8 figures annually. Here's the kicker: you don't need a Rockefeller-sized fortune to start playing the game. While the elite pay $2,500 per hour tax attorneys, platforms like Masterclass now teach offshore structuring basics for $15 a month. Study 1031 exchanges to defer real estate gains or explore opportunity zones for capital gains tax elimination. Remember, Jeff Bezos funded Amazon through a $250K family loan, a move any middle-class parent could replicate via a cash-value life insurance strategy. The true secret? Think in epochs, not earnings. The Vanderbilt's 19th century railroad empire dissolved within generations. Today's dynasties use GRATs, grantor-retained annuity trusts, to freeze asset values for heirs and private trust companies to bypass probate. Meanwhile, 12-year-olds in Manhattan prep schools trade crypto in UTMA accounts, their allowances structured as taxable gifts to leverage annual $18 exclusions. Now, let's unpack why New York City is called the Big Apple, a term born in the 1920s jazz scene when musicians chased apples, slang for gigs, here. By the 1970s, a tourism campaign revived the nickname, cementing New York City as the ultimate prize. Today, it's a billionaire's playground, with ambition etched into its ever-evolving skyline. The city now boasts 86 skyscrapers over 600 feet tall, more than any other metropolis on Earth. Leading the pack is 111 West 57th Street, nicknamed Steinway Tower, a 1,428-foot engineering marvel completed in 2021. This super slim skyscraper, just 60 feet wide at its base, symbolizes New York City's vertical arms race for exclusivity. Nearby, Central Park Tower, 1,550 feet, reigns as the world's tallest residential building, where penthouses list for $250 million, complete with private elevators and 360-degree views. But the crown jewel? A $238 million duplex at 220 Central Park South, snapped up by a hedge fund titan, leveraging NYC's 421A tax abatements to slash annual bills by millions. But here's the real game. The ultra-rich don't just buy property, they strategically optimize it. They funnel assets into dynasty trusts to sidestep estate taxes, educate heirs on real estate investment trusts, REITs, before they hit puberty, and capitalize on NYC's triple threat of global finance, culture, and talent. High-profile investors quietly acquire Tribeca brownstones as inflation-proof heirlooms, while tech moguls and oil tycoons park fortunes in condos at 432 Park Avenue, $88 million units, or 520 Park Avenue, a billionaire bunker with bulletproof windows and panic rooms. Why? Status, scarcity, and strategy. NYC real estate has surged 45% since 2010, and savvy owners deploy 1031 exchanges to defer capital gains taxes indefinitely by trading up properties. Your move? Start building your family office today. Automate a $500 a month SEP IRA if self-employed, tax-deductible contributions up to $69,000 a year. Negotiate equity over salary to defer taxes. Amazon's early days were funded through a $250,000 family loan strategy. Convert hobbies into LLCs to deduct expenses, like one entrepreneur who wrote off a $15K Rolex as a marketing tool for his luxury watch YouTube channel. New York's elite aren't geniuses, they're just earlier. Take the cosmetics mogul who sold creams in 1940s hair salons before scaling into a $22 billion empire. The lesson? Generational wealth starts with cunning, not capital. The secret sauce? Think in centuries, not quarters. While 19th century dynasties crumbled within generations, today's ultra-wealthy deploy GRATs, grantor retained annuity trusts, to freeze asset values for heirs and private trust companies to bypass probate. Even preteens in Manhattan prep schools are groomed for wealth preservation, trading crypto via UTMA accounts, their allowances structured as taxable gifts to leverage 18K year exclusions. NYC's architecture mirrors this long game. Steinway Tower's 84-year construction timeline reflects how dynastic families plan beyond lifetimes. Before you go, thank you for watching. If this hit different, smash that like button, subscribe, and ring the bell. Now, debate time. Which strategy shocked you most? The $250 million penthouse tax hacks? Turning hobbies into LLCs? Crypto-savvy 12-year-olds? Drop a comment. I'll reply. Stay hungry, stay investing, and remember, the game isn't about getting rich, it's about staying rich. Catch you at the top.